Hello, everybody. Welcome to another edition of Perry Home Solutions, bringing you valuable information. I'm here with the lovely and fabulous and one and only Julie Perry.
Julie Perry, Perry Home Solutions, helping buyers and sellers in Palm Beach County, Florida.
All right, Julie, what are we here to talk about today?
Okay, so today we're going to continue with our mortgage hack series. And the topic of today,
Mortgage hacks are really important because mortgages are like a major problem
right.
now.
And if this is your first time watching this, is basically how to get creative around getting mortgages and making it more affordable or easier to qualify.
And equally important, how to use different strategies to make an offer more appealing if you're a seller, to make your house more appealing to a buyer that's having trouble with financing too, right?
Right.
Yeah.
So today's topic on that is seller financing. So if you never heard of that, basically how it works is when your home is sold through seller financing, the seller now becomes the lender. And so normally when the bank would be your lender, in this case the seller, the owner of the property would become the lender.
Right.
That's what that means.
Got it. Yeah.
So let's talk about, you want to talk about the value to the sellers, why it would be beneficial?
Sure. We're going to start with the value to the seller.
We do both.
Well, let me start a little bit with the value to the buyer.
Okay.
Because maybe a seller would find it really valuable, but usually most of the experience that I have with seller financing, the seller offers it as an incentive to a buyer. Because if a buyer has a little trouble obtaining financing, or in this market, interest rates are really high, so maybe you might decide to mitigate that to a small degree. This can be a really valuable tool to use in order to attract buyers, give them additional financing options that they can't get in another house. So this is a financing option that's only available for your house, as an example. So it's kind of a marketing tool for sellers.
Right. And something that's also mentioned here, as a seller, of course, you will have to have your house paid off or have a balance that is small enough that you can pay it off with the down payment.
Yeah.
Because you really can't do that if you already have an existing mortgage that you have to pay off, right? The advantages could be reduced capital gains, tax savings, and the ability, I guess, because at that point...
Who are these advantages for?
The seller. We're still talking about the seller, right?
So reduce capital gains for the seller. That's right. Mm-hmm. Yeah, that's a good one.
And I guess the ability to not have to be responsible for the insurance, taxes, maintenance, but since you're the lender, you still have certain...
Right.
I don't want to say power. What would be another...
Well, so I think where you're going with this is you're saying that, you have a couple of options. You could just sell it outright and to a buyer that you don't provide financing to and just get the money. You could rent the house, right? But then you have all the headache of owning the house, having to maintain the house, having to collect the rents, so on and so forth. And then this is sort of kind of a hybrid where you're selling it, but you still have a somewhat of an interest in the house and income being generated off the house, but you have zero responsibility to maintaining the house or collecting
insurance
rents.
And things
Now,
like that.
you'd have to collect mortgage, but you have a instrument in the mortgage that you don't have in rent, which is called foreclosure, right?
Right. Yeah. And the advantage for the buyers that we were talking about? No.
I don't think so.
No. Okay, so the advantage of the buyers, of course, there will be the ability to qualify potentially more flexible terms because you're now being qualified by the owner and not by the lender. Lenders have very specific and sometimes very stringent guidelines that they have to follow, Fannie Mae, Freddie Mac.
Like as an example, when you go to qualify for a loan, a lot of people get flustered because we'll have clients that have a whole bunch of money in the bank. Like some of them are actually quite wealthy, but they can't get a mortgage because they give mortgages mainly based on income, right?
Like you could be retired and have a substantial nest, right? But if you don't have any real income,
you as an owner, a bank doesn't care about your in your story, but you as an owner might say, oh, well, this guy has tons of assets. I might be very comfortable loaning him the money and writing seller financing on it. So anyway, that was my 2 cents.
And it could potentially also be an interest. Maybe the seller will be willing to offer a lower interest than what the bank would give you, which now,
maybe. But I guess we got to be careful with that because maybe you wouldn't. Maybe the incentive to loaning the money is getting a better interest rate. I don't know. But,
well, it depends on the circumstances, obviously. We're just talking about all the possible scenarios as to why it would be a good thing. Okay, so that is value on seller financing. Now, there's other common seller financing agreements that are similar but different also in a way. This one, let me see. I'm not super familiar with this one. Land contract. An agreement to purchase a piece of real estate that involves buyers borrowing money from the real estate owner until the purchase price is paid in full. Land contracts typically work with a balloon payment or a lump sum comes at the end of the repayment period after the plan is agreed upon between two parties.
Okay.
Sure. Yeah.
Got it.
Lease to own, that one's more common. We're very familiar with that one.
Yeah, this one we know quite well.
So it's a formal agreement under which renters pay sellers an option fee at an agreed upon purchase price that gives the renter the exclusive lease option to purchase the property at a later date.
Right.
Want to go into more details as to what that looks like?
So to break it down, so basically what a lease option is, you can kind of explain it very simply because it in the name, it kind of spells it out, very accurately. It's a lease, like basically a standard lease that you would sign. Plus there is an option, which is like an addendum to the lease to purchase the property. And what's common is along with the option would be actually a purchase contract. So you have a normal lease, you're obligated to the 12 months of the lease. And then you have an extra document, usually it's like 1 page, and it's an option to purchase. And it basically says that anytime within that 12 months, you have the option to purchase this property at these predetermined
price.
In terms and price. And then you've already struck a contract that is contingent on that option being exercised. With those terms spelled out, price is obviously the big one. There's deposit, we don't have to get into all that. But anyway, that's how it works. And did you have a question on that?
I was just going to say, well, what would be the advantage of someone, instead of just buying today this house, why would they consider lease to own?
Well, the same reason that you'd consider seller financing. It's very similar to seller financing in many ways. Because some of the elements that you can build into a lease option, as an example, you could say that a certain percentage of the payments per month get allocated towards the purchase price.
Or towards a down payment deposit.
Same thing. Yeah. It's the same exact thing, right? And then so when you do that, that's almost identical to a mortgage. That's almost identical to a mortgage payment because it's the same thing, right? And then so in essence that kind of mirrors seller financing to a large degree. Now the difference is there's good and bad and ugly. One of the good parts is you have an option. So let's say, as an example, the real estate market goes down and it's no longer worth what you guys had originally agreed to, or maybe other things have changed. You can just decide not to exercise that option.
Just finish the lease and move, and that's it. Right?
You could theoretically, let's say the value increased significantly, you could execute the option and then sell it to somebody else for a higher price. Or, in theory, you might even be able to structure it where you can actually sell the option to somebody else. And so you could actually just sell the right to buy this house that you have an option at $400,000 that's now worth $500,000. You could sell that option, for let's say $20,000. They get a house at $80,000 discount. You just made $20,000. That's or whatever. There's a lot of ways to play that.
Right.
The other element to the lease option that's really important is the option consideration, which you had mentioned.
Right.
Right. So that is an upfront fee in addition to your normal lease stuff. Yeah. So you'll give the seller like a few $1,000s commonly, and that's their money to keep. And that is one of the incentives for an owner.
Seller, right?
Right.
For the owner, yeah.
Yeah, because there are some downsides to this, right? Like let's say you didn't want to lease your house, and you agreed to do this. You could get that house back. And then leasing a house has downside, right? I mean, you could have to go chase them for rent. You could have to evict them. There's a lot of negatives. So it's a way to
mitigate some of those risks.
Yes, and also to encourage the owner to agree to sell it and agree to that option. Because having an option is powerful. When you have an option to do something, that is a huge advantage that you have over the counterparty. Because you could decide not to. Because an option is unilaterally binding, and if you exercise it, the other person has to oblige.
Right.
They don't have a choice. If that house goes up by $100,000 and you have $100,000 in equity, that is tremendous because they may say, well, I don't want to sell it to you anymore. I'd rather sell it to somebody else for $100,000. Sorry, we have an option. It is a legally binding agreement with a signed contract.
You told me that you were going to sell to me for this price, and I'm going to buy it from you.
And that is how it works. That's the legality of it. And so I now will enforce that option. I will purchase that property, and now I will have that $100,000 in equity, and that's the value, right?
Right.
And in addition to all that, in addition to the the money allocated from the payments per month, which can be negotiated. It's not necessarily a given, but it's common. You can also negotiate the option consideration amount that you pay up front also is allocated towards the purchase price.
Yeah.
So you could structure it where if you do it correctly, in some ways it's almost better than seller financing for that period of time. And if you structure it in a way that you could have it go in over the course of multiple years, now you basically just arrange seller financing for 2, 3, 4 years.
Multiple year lease
Sure.
option. Yeah.
Yep. Anyway.
Not to get too into the weeds.
Well, I think lease options are fascinating. And when they're applied correctly, they can be an extremely valuable tool. And there's a lot of other bunny trails we could go down. Like as an example, you could have a subordinate lease option where you lease option it and have the right to sublease it to somebody else.
So you don't have to live. You don't even have to live in the property.
No. So you could buy a property essentially zero money down, right? Very little. It may be first lasting security or something like that, right? Mm-hmm. Have the right to purchase it and then sublease it to somebody else, make a profit off of the difference between the lease that you have and the lease that you're leasing to somebody else. And also,
that's a lot of components.
but that's what it can be used for,
I get
right?
you,
That's There are people out there that do Airbnbs where they'll lease the house, have the right to Airbnb it, and they will manage the Airbnb themselves on a house they don't even own. And this is, that would be a whole other bunny trail as well. But there's a lot of interesting strategies that you can use with lease options. Anyway, so
if you want to get into it more, give us a call.
I don't know how you possibly get into it more than that, but if you'd like to, I'd be happy to. So.
Very good. And the last one, let's talk about assumable mortgages. So that the definition of that is a type of home financing in which buyers are given the opportunity to purchase a home by assuming responsibility for and taking over the seller's current mortgage.
Right.
And this ties up a little bit on a previous video that we did about VA mortgages, since they are assumable mortgages. Just side note. But yeah, basically, assumable mortgages could be an interesting option for a buyer and give them options to, maybe a mortgage with a lower interest rate and things like that, better terms.
Yep. Yeah. So do we want to dive into assumable?
Sure.
So assumable is a very interesting thing because in this particular environment that we're in, we have this weird juxtaposition of interest rates where, a lot of people a little over a year ago have interest rates that were locked in at 3%, and the current interest rate is like almost 7%. And so that's a real big slap in the face to some people that are looking to buy. And so assumable mortgages have become incredibly valuable right now because if you have a mortgage that's assumable at a much lower rate, that's a rate on a very good mortgage instrument that nobody else can get. Mm-hmm. That's huge.
Right.
And you talk about saving money to the buyer and everything else as an incentive to buy your house. It's a pretty tremendous incentive.